All right. Let me know when the screen is visible to all. Let me know when the screen is visible to all.
Yes, sir, it's visible.
Yes, sir.
Visible? All right. Let's begin our discussion for the day. Now, I'm purely talking about to begin with liquidity ratios. Now, first of all, let us speak about the meaning of the term liquidity. What is liquidity? The ability, liquidity is nothing but the ability to pay your current outstandings out of your current assets. So what is liquidity? Liquidity is nothing but current assets minus current liabilities. If current assets minus current liability is greater than 0, you are liquid. If current assets minus current liability is equal to 0, you are still liquid. But if current assets minus current liabilities is less than 0, that is, it is a negative number, you are not liquid. You are not liquid. In these first two cases, you do not need additional funds to repay outstanding, that is to repay your current liabilities. But in this case, you need additional funds to repay your current outstandings. What happens in such a case? You are forced to borrow. Or you are forced to issue more shares. Or you are forced to issue more capital. In any which scenario, you don't have enough money at the current point in time. You don't have enough money at the current point in time to repay your outstandings. Does everybody present in the session agree with my statement? Does everybody present in the session agree with my statement? Yes or no, please tell me that. Yes or
sir.
no, please tell me that. Do you agree with my statement?
Yes, sir.
Yes? Just a second, guys. Right. So you need to borrow money. Is that a good sign or is that a bad sign? That is a bad sign. This over here is a bad sign. Why is this a bad sign? This is a bad sign because you don't have enough money. Now keep one thing in mind, where liquidity position is threatened, over there long-term solvency is under threat or under question when you are not liquid. What is the meaning of long-term solvency? Long-term solvency is the ability to repay your long-term borrowings and interest thereon. So for somebody who is not able to pay, look at it like this. If you are not able to pay your gas bill and your electricity bill, you are not able to pay your car insurance on a whatever monthly or a yearly basis, can you pay your loan EMIs? You can't pay your loan EMIs. That is not possible for you to do. Therefore, on a long-term basis, you are not going to be able to have, the position to meet your long-term liabilities. And for somebody who cannot repay their debts, for somebody who cannot pay the interest on the debts, what happens to that person? What happens to that person? That person is known as Vijay Mallya. That person is known as Ramalingam Raju. that person is known as Nirav Modi, that person is known as Mehul Choksi, that person is known as Subrata Roy. Who are all these people? Defaulters of long-term loans. They have run away from India. Modi, Choksi, Malia have run away from India. Ramalingam Raju is out on bail and Subrata Roy passed away recently. So basically you're a fraud if you're not able to pay your debts. Are you understanding what I'm trying to say? Yes or no, please tell me that. Everybody, are you
Yes.
with me on that? Now, whether or not your company is going to be in a position to pay these debts, these outstandings, you will use a tool called ratio analysis for the same. In ratio analysis, our focus will be on what ratios? Our focus will be on liquidity ratios. Does everybody agree? Yes or no? All of this has been previously covered in our earlier lectures. The recordings are available for us to see. I am just doing a quick 15, 20, 25 minutes recap so that this coupled with that gives you a fresh perspective for solving your MCQs. This is what happens. Now let's take a screenshot of this and let's put it in our notes for the day. Now, let's go ahead. Now, if I was to speak about liquidity ratios, as I said, what is liquidity? Liquidity is the ability to pay the outstandings. Outstandings have a different word, a more technical word, that is current liabilities, out of current assets. So the first ratio that we come for and we talk about is the current ratio. What is the current ratio? It is current assets upon current liabilities. Now, what is the meaning of current? Current means they are receivable in the case of assets, or in the case of liabilities, they are payable both within how many months? Within 12 months. And when I talk about non-current, they are for assets receivable, and for liabilities they are payable beyond 12 months. Means, for example, if you are using a fixed asset, you will use it for more than 1 year, and the asset will help you generate the cash flows, owing to which then cash will be receivable. Why? Because you will generate sales from it. For example, you have a 5-year loan, you will pay it over a 5-year period and not within 12 months. Now, what are the current assets that we are normally going to deal with? Always remember, begin with king. Cash is king. Cash, accounts receivable, notes receivable, marketable securities, inventory, and prepaid expenses. What are these? These are your general set of current assets that you are going to encounter. Divide them by what? Current liabilities. What will you generally find in current liabilities? Accounts payable, notes payable, outstanding expenses, short-term other liabilities as is mentioned in the question, plus other data that is mentioned in the question. So you ask me to put a list, maybe this sheet also will not be more than enough. But we go question wise. So these are your current assets, these are your current liabilities. If the current ratio, is more than 1, if the current ratio is more than 1, it shows that current assets are greater than current liabilities. If the current ratio is less than 1, it shows that current liabilities are greater than current assets. Here you are liquid and here you are not liquid. This is what you need to understand. Out of these current assets, there are some assets known as quick assets, that is, they are immediately convertible to cash. What are your quick assets? Cash is a quick asset. Accounts receivable are considered to be quick assets. Notes receivable are considered to be quick assets. Marketable securities, short-term marketable securities and investments are considered to be quick assets. Inventories are considered to be non-quick assets, and prepaid expenses for the purposes of working capital calculations that we do in India, we consider prepaid expenses to be quick. In India, we consider only inventories to be non-quick. But various American authors consider prepaid expenses also to be non-quick. Baker has made its notes in such a manner that all prepaid expenses are considered to be non-quick assets. That's an addition in your existing understanding. Current liabilities in India are classified as quick liabilities and non-quick liabilities, where the only non-quick liability is considered to be bank overdraft. But for the purposes of the drafting of the US CMA syllabus, bank overdraft is always considered to be a long-term liability, a long-term borrowing. This is a guide that has been issued by the IMA. So let us not challenge them in their understanding. After current ratio, and of course, current ratio has a rule of thumb that the ideal current ratio should be 2:1. What is the meaning of this? The meaning of this is current liabilities should be covered 2 times by current assets. So 2 times of current liabilities is equal to your current assets. So current assets upon current liabilities should be equal to 2/1. If that is the case, obviously 2 times current liabilities is equal to current assets. The moral of the story is you should be able to repay your current liabilities out of current assets, and current assets should be 2 times that of current liabilities, owing to which you don't have to borrow money from anywhere at all. This is a quick recap of your current ratio. Now, having said this about your current ratio, let us go ahead and let us move towards the next ratio, that is your quick ratio. Purposely, I'm going to write this in red only because I have done the highlighting in red. Quick ratio is nothing but your quick assets upon your current liabilities. Keep this much in mind. What are your quick assets? As I said, cash. As I said, accounts receivable. As I said, notes receivable. As I said, marketable securities divided by your current liabilities. All of what you have put here, these are your current liabilities. Quick ratio ideally should be 1:1. It should be 1:1. Now, what is the meaning of quick ratio? Please understand here, quick ratio does not rely upon inventory to generate cash flows. The question is why you don't rely on inventory. See, today I have this stock. This is a bottle of Mountain Dew. Today it's in demand. People will buy this Mountain Dew. Tomorrow there'll be some health craze. People will say, don't have aerated drinks. They're bad for health. They give you arthritis. They give you diabetes. They give you weak bones. God knows what not. And suddenly there is a spurt or a downward spurt in the consumption of Mountain Dew. What will happen? My inventories will not sell. There is no guarantee that I can give that my current assets in the form of inventory are going to be sold all the time. So there's no guarantee that my inventories are going to realize cash. But cash is cash. Receivables will be collected. Notes receivable will be collected and marketable securities will be sold. These are the basic operational assumptions that we have to make. So quick ratio does not rely upon inventory to generate cash flow. Therefore, inventory will not be considered in the calculation of quick ratio. Now look at the next thing. See, when it comes to prepaid expenses, please understand this concept about prepaid expenses. What is the meaning of prepaid expenses? That you have paid an expense in advance. Are you going to receive any money against it? You are not. For prepaid expenses, you will receive either the services or the goods. You will not receive any cash. Say for example, you pay my fees in advance. I will give you services. Say for example, you pay your monthly grocer's bill in advance. He will give you goods. Will I give you money? Will your grocer give you money? No. Nobody is going to give you money for prepaid expenses. उसमें कोई पैसा मिलने वाला नहीं है आपको. पैसा आप दे चुके. पैसा आप दे चुके हो. You have already paid the money. What are you going to get? Goods or services? Am I absolutely clear about this? Yes or no? Please give me a thumbs up, all of you. Give me a thumbs up for all those of us who have understood these concepts so that now we can jump into the questions. Does everybody understand? Yes or no? Yes? All right. All right. Now let's take a screenshot of this as well. This will be a quick revision for you when you will read the PDF of MCQs today. Right now.
Yes, sir.
Yeah.
Yeah, I'm not able to understand as I'm a newcomer. As you have discussed one of my friend with Anshika.
Yeah.
You remember, sir?
Yeah.
So I joined right now. So how can I catch you? Like, how can I understand these concepts? Will you be repeating or something else will happen?
There are recorded lectures available where we have taken 3.5 hour sessions on all of these concepts.
Okay, sir.
On joining with Apex, you will get a complete data dump of these lectures. I have only
Okay.
taken them.
So when
After
it
watching,
yes, when it was started. The,
this has started. We have finished one chapter, and we are
okay.
in the process of doing this particular chapter.
So how many hours will it be taking? Like
You
to
probably need to look at somewhere about 8 odd hours of lectures, which you can complete in probably 2 to 3 days.
So right now, will it make sense? Like,
Oh,
shall I
yes, it
sit?
will. You have to
Okay.
do your best in trying to understand all
Okay,
the
okay.
concepts that I'm trying to teach you.
Okay, okay, sure, sir.
If I give you a formula and I ask you to substitute numbers in that formula and you're sitting with a calculator, will you be able to substitute it?
Yes, yes, I'll be.
That's it. Take all the
Definitely.
efforts that you can. The understanding will happen, right?
Yes, sir.
Take all the efforts possible. If you're not understanding a calculation, ask me.
Definitely, sir.
And nothing of what I said is Greek and Latin. It is easy to understand. You have heard these terms multiple times. You just need that little bit of a motivational push, which you will get from the pre-recorded lectures. And if you have a doubt, you can ask me.
Sure, sir.
And you can ask any one of the students present over here. If there are doubts, do we or do we not clear them? Don't worry. If necessary, we'll sit with you one-to-one and solve your doubts as well. We'll be happy to do it for you.
Thank you, sir.
My pleasure. All right. Let's start the game of financial ratios. I am in Baker right now. The objective is Baker को finish करना है, then Sargent को finish करना है, and then more additional questions will come your way. So we are at Baker right now, and in Baker I am doing. See here, I am on unit number 1. In that I am doing financial ratios part 1. There are 54 questions. I am starting with these 54 questions, and as told to you in the beginning of the session, today's focus is on the liquidity ratios, which are probably the first 30 odd questions that are there. Now, Danish, I want you to pay attention. Nasla, I want you to pay attention to how we solve the MCQs. This is not a session about ticking the right answer. This is a session about understanding why the right answer is the right answer and why the others are wrong. Right? Let us begin. All of the following financial indicators are measures of liquidity and activity. Please understand, we are talking about measures of liquidity and activity. What is the meaning of liquidity and activity? Liquidity is ability to pay your current liabilities, and activity are your operations. Except for one of the ratios, merchandise or inventory turnover. Merchandise or inventory turnover is purely a liquidity ratio. It counts how many times in a year your inventory is converted to cash, and it is related to activity. So it counts how many times inventory is circulated and inventory circulation is nothing but your operational efficiency. How many times are you able to sell in a year? Next, accounts receivable turnover counts how many times the accounts receivable, that is your debtors, pay you money, and efficiency in collection of money times interest earned ratio. Well, this covers how many times earning before interest and taxes cover interest payable. Let us understand this in slightly more gravity. Earning before interest and tax divided by interest payable. My dear students, let's begin a simple conversation. Sales minus variable cost. What will you get? Contribution. From contribution, I will subtract my fixed cost. What will I get? I will get EBIT. In part 1, marginal costing, we used to call this profit. In part 2, financial management, we call it EBIT. We have discussed this in yesterday's lecture also. Remember? I hope so. From this, I will subtract my interest on borrowed funds. And I will be left with earning before taxes. Now, my dear friends, interest on borrowed funds is paid out of EBIT. Please understand. Interest on borrowed funds is paid / met out of EBIT. So EBIT should have the power. So basically what I'm saying is EBIT should have the power to pay the interest. EBIT should have the power to pay your interest. Now suppose EBIT is 100 and interest is say 15. So can I say that interest can be paid 100 divided by 15, which is somewhere more than 6. So 100 divided by 15, it can be paid 6.7 times out of EBIT. So the EBIT that I have has got that much muscle power that it can pick up the load of interest 6.67 times. Do I have to worry about my long-term solvency? No. I can pay interest 6 times out of the money that I have generated. This is not a measure of liquidity. This is a measure of solvency and operational efficiency. Why operational efficiency? Because EBIT आखिर में बच्चा तो सेल्स का ही है. EBIT की अम्मी और उसके अब्बा कौन है? सेल्स है. Operational efficiency is counted. There is no doubt about it. But my dear friends, you are asking for liquidity and times interest on borrowed funds. When I started this lecture, I told you very clearly, it is a beacon of solvency and not of liquidity. How many of my attendees understand this stark distinction that interest is solvency, it is not a liquidity? How many of you understand this? Kindly give me a thumbs up. You understand this aspect, this concept? Who all does? Yes or no? So Ritvik, yes, everyone, you understand it? So Danish, Nesla, what you probably have to remember is that when I'm talking about liquidity, over there interest and long-term borrowings are not covered. Watch the lectures, you will understand. What is covered in liquidity? My ability to pay my current liabilities. Accounts payable, notes payable, outstanding expenses, etc. Next comes acid test ratio. Boss, what is acid test ratio? It counts whether quick assets can bear my current liability. It is outrightly liquidity. And over and above it, the fact that I have those many quick assets is also a beacon of operational efficiency. So answer number 3 does not count liquidity and activity. It counts solvency and activity. This counts liquidity and activity. This counts liquidity and activity. And this counts liquidity and activity. Therefore, by that reasoning, my answer will be times interest earned ratio. I hope everybody understands this aspect, and that's your first MCQ for the day along with explanations, right guys? So we put it down over here. My existing students, are there any doubts? Are there any doubts? So Monica had given me the answer. Fantastic. I think it was Monica who gave me the answer. No, it was Vivek, and I think it was Monica also. Yeah,
Yes,
Vivek
sir.
and Monica gave me the answer. Yes, very good, Vivek. Very good, Monica. Monica, I expect. Vivek, very good. It's not that I don't expect. I do. But Monica has attended it regularly. Right? So let's go to the next question. Now, this is your question number 2. Also, when it comes to Becker, I want you to keep one thing in mind, that keep this number over here. You see this number over here. Keep your eyes open for this particular number. This is your MCQ number. While you solve Becker on your own, if there is a doubt, note this MCQ number and tell me this number, and then we will take it up for all our doubts and things like that. I hope that is clear. Let's go to the second question. Which of the following, this is a fantastic question. Which of the following will decrease your current ratio and increase your current ratio and decrease your net profit? My dear friends, don't jump to an answer. Let us analyze mathematically the answer. Let us analyze mathematically the answer. Now, please focus. What are they saying? They are saying the objective. They are saying the objective is, what is the objective in the question? The objective is to increase the current ratio. Hold on. You want to increase the current ratio. Now hold on to your guns. What is the formula of current ratio? It is current assets upon current liability. Please, my dear students, use your head. When does the ratio increase? The ratio will increase when current liabilities, that is the denominator, will decrease, or when the current assets will increase. This is a clear indication of the increase in the ratio. Now, they are asking you, it will increase the current ratio and decrease the net profit. They are saying decrease in net profit. So a decrease in net profit will either be an expense or it will be a loss. It will be an expense or it will be a loss. More often we are looking for loss. Okay. Now they are giving us certain cases. Let us see what cases they are saying. Federal income tax due from previous year is paid. What are they saying? Previous year income tax is paid in the current year. Is paid in the current year. Now, my dear students, in accounts we follow something known as accrual concept. Please understand, previous year's income tax is expense of previous year. It is not an expense. It is not an expense of current year. How many of you agree with the statement that I just made? Previous year income tax, previous year expense. I've got nothing to do with it in my current year. When was this expense coming to me? In the previous year. So am I bothered in the current year? Yes or no, you tell me that. Am I bothered in the current year? No. It does not impact the profits of the current year. Then what does it impact? Please pay attention. It does not impact the profits of the current year. It impacts cash position of current year. What do we want? We want an increase in the current ratio and we want a decrease in the net profit. There is no decrease in the net profit, but there is an impact on the current ratio. Here, I am going to purposely stretch this example a little more. I'm going to chew on this like chewing gum. Now, please pay attention. I am taking 3 cases because this clarity will help you pass your group. Please pay attention. In case A, I am saying my current assets. In case A, I am saying that my current assets, as per what little data I am taking, my current assets are, let us say, 2 lakhs. And my current liabilities are, let us say, 1 lakh. In case B, my current assets are 1 lakh and my current liabilities are also 1 lakh. And in case C, my current assets are 90,000 and my current liabilities are 1 lakh. Why did I take three different cases? In the first case, current assets is greater than current liabilities. In the second case, current assets is equal to current liabilities. And in the third case, current assets is less than current liabilities. All the three possible instruments of analysis I am keeping in front of you. But Pushkar, why are you doing this? I know clearly that it is not the answer. Leave aside decrease in profits. What if they were asking you only about increase or decrease in current ratio? You will be confused with this. Now let me assume that, for example, income tax payable, it is 10,000. In all the three cases, I am saying income tax payable for you is how much? It is 10,000. Does everybody understand the three case scenarios that I have created for you? Kindly give me a thumbs up, yes or no. I will move ahead only after I know that you have understood this, because it's a very delicate conversation that comes your way. Everybody, are you understanding? Now focus. Hi Haripriya, nice to see you here. Now, let us begin. After I pay this, I am paying this in cash. So, of course, my current assets will go down. Now, my current assets will be 1,90,000 and my current liabilities also will be 90,000. Why Pushkar 90,000? Because this income tax payable is a current liability. It is 10,000. Out of 1 lakh, I paid 10,000. So, I am left with 90,000. In this case, notice that my current ratio was 2:1, was 2:1. Now, how much it will become? 190 divided by 90, the answer will become 2.11:1. My dear God, what happened here? Over here, my current ratio actually increased. Okay. So they are saying increase in current ratio. Yes, it is achieved in case A. Let us talk about case B. In case B, my current ratio was 1:1. Why? Current assets upon current liabilities. Current assets upon current liabilities, 1:1. Right? Over here it is 2:1. Right? Over here it is 0.9:1. Now let us see what happens. Over here now my current assets will become 90,000 because I paid out of cash, and my current liabilities will also become 90,000. Surprising, my ratio stays 1:1. Here my current ratio is unchanged. Suddenly, this starts looking like the wrong answer. This analysis was important. I proved it can increase. I proved it can decrease. Third, now see what will happen. Here it is this much. Now what will my current assets become? Now they will become 80,000 because I am paying 10,000. My current liabilities will become 90,000. So what will be my answer? 8 divided by 9. And it is 0.88, if I am not mistaken, 8 divided by 9. Now it will become 0.88:1. Here what has happened? Current ratio is decreased. On the basis of previous year's income tax is paid in current year without data. My dear students, without data, I cannot holistically conclude whether it will increase, whether it will stay unchanged, or whether it will stay decreased. Does the question give you any data? Answer me. Unmute and answer me. Does the question give you any data? Does the question give you any data? Yes or no?
No.
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 Any data?
No, sir.
Then how in God's
No.
good name are you saying it will increase? Monica says it will increase. I am debating it will stay unchanged. Aditya will say, go to hell, it will decrease. All three of us are looking at each other and we are all correct as per our understanding. Agreed? Without data, I cannot conclude. I cannot conclude if CR will increase or CR will decrease. CR means current ratio. CR means current ratio. I can't conclude. I just can't conclude. So option number one, current ratio increase, I can't conclude, but decrease in net profit is not going to be there because it is the expense of the last year. It does not impact the profit. It impacts the cash position of current year. That is okay. It will impact cash flow statement. So do you understand, and is it justified why previous year's income tax? Why previous year's income tax is not the right answer? It is not the right answer. Let us go to the next point. Please let us go to the next point. A long-term bond is retired before maturity at a discount. Now hold on. Let us take a screenshot of this much. And let me see the question number. I'll put it 3, 4, 5, 6. Now hold on. This is Baker. Question number 2, MCQ number 3, 4, 5, 6. Right? This is a big discussion. And it's essential because this discussion will prepare you to face these kind of MCQs more and more. Now hold on. Now what they are saying, a long-term bond is retired before its maturity at a discount. Sir, I didn't understand the meaning only. Don't worry, I'll explain you. There is a long-term bond. What is a long-term bond? A long-term bond is nothing but a long-term borrowing. Long-term bond is nothing but a long-term borrowing. Let us say that I have borrowed $1 lakh for 5 years, is redeemed or repaid or retired, is redeemed, retired, repaid before maturity. And the next point is very, very crucial, at a discount. What is the meaning of it is redeemed, repaid at a discount? You will take 100 and you will give 90. Means you will give less than what you are taking. Okay. Now the bond is a liability. The bond is a liability. Liability has what balance? It has a credit balance. Now this bond is being retired, repaid means it is being removed from the books. It is being removed from the books. My dear friends, tell me one thing. Tell me one thing. If you are removing it from the books, it is a liability. Will you or will you not debit it? Because now it is no longer staying in your books. Will you or will you not debit it? Come on, guys, tell me. Yes or no? Will you or will you not debit it? You will
Yes.
debit it?
Debit.
Agreed or disagreed? So, sir, pass the journal entry happily. Please pay attention. Long-term bond account debit. What is the value? As per my example, it is 1 lakhs. Sir, it is being paid at a discount to bank account because money is going out. 90,000 has gone out. And to discount on redemption. My dear friends, this is a gain. This is a gain of 10,000. This is a gain of 10,000. But bank going out shows that my bank balance has reduced. Therefore, when I write current assets upon current liabilities, my current ratio will reduce. Agreed or disagreed? You tell me that. My current ratio will reduce because my numerator will fall and my denominator will stay unchanged. Secondly, these are current liabilities and you need to understand that long-term borrowings are non-current liabilities. Yes or no? Please tell me that.
Yes.
So, can I say that my current liability position is unchanged, but my current asset position is falling. Therefore, my current ratio is falling. The question asks me a very basic covenant. And what is that? Which transactions will increase the current ratio? Boss, increase the current ratio. Here the current ratio is decreasing. What does the question want? Question wants an increase. This is a decrease. So is this my answer? No, sir, it is not my answer. Therefore, this option, this was your option number B, is a wrong option. It cannot be your answer. It is 3, 4, 5, 6. Right? We are continuing with Baker 3, 4, 5, 6. Does everybody understand why option number B is the wrong option? Why it is not your answer? Why I am not ticking it? Yes or no, give me a thumbs up. Yes or no, give me a thumbs up. Agreed? Everybody understands? Okay, let's go ahead. Let's take a screenshot of this. Put it to our notes. Now let's move on. Let's go to the third one. A dividend is paid. Interesting. My dear friends, what are they saying? Dividend is paid. Now let's take a look. Dividend is paid. Now let us understand a few things from the perspective of corporate law. What does corporate law and accounting say about dividends? FR means financial reporting. What does they say? They say first you declare the dividend. On declaration of dividend, dividend will become a liability. Dividend now becomes a liability, so dividend becomes payable. And then what you do? You pay the dividend. Means what? You satisfy the liability. Am I clear about this? You satisfy the liability. So dividend you are going to declare. Now dividend becomes payable and now you satisfy the liability. A liability has what balance? Credit balance. Now when you satisfy it, what will happen? It will be debited. It will be debited. So can I pass the journal entry? Dividend payable account debit to cash bank account. Yes or no, please tell me that. Whatever is the amount of dividend, suppose 10,000. Suppose 10,000. Agreed or disagreed? Suppose it is 10,000. Are you with me on that? What has happened because of this? Yes, there is an expense in the current period. Yes, there is an expense in the current period. But the cash balance of current year is going down. Current assets are going down. And my current ratio will not increase. My current ratio will not increase. There will be an expense in the current year. But my current ratio will not increase. What does the question want from me? The question wants from me that current ratio should increase and profit should decrease. Yes, profit is decreasing. I am not saying no. But my current assets are going down. Agreed or disagreed? Please tell me that. Agreed or disagreed? Please tell me that.
But sir, dividend payable to liability account नहीं हुआ.
Appreciate. Do you have the data over here? Ki how
No.
much is the dividend? How much is the cash?
No sir.
Don't have. And I told you, without any data, you can't take a call. Remember, I did those 3 cases.
Yes, yes.
So, you can argue that dividend payable is a liability. But without data, current ratio can increase, current ratio can decrease, and current ratio can stay unchanged. Can you give me a guarantee that current ratio is going to increase on the payment of this dividend payable liability? You can't give me a guarantee. Why you can't give me a guarantee? Because you don't have data. Suppose you had data, then I will have said, chalo, let us calculate. I'm sure we will get an answer. But we don't have any data. So without any data, I cannot say what will happen. Agreed? So it can't be my answer.
Yes,
Agreed
sir.
or disagreed?
Agreed sir.
Agreed? Okay.
Yes.
Take a screenshot of this. And it's not just her, everybody else. Do you understand why I'm saying you can't say? Because there is no data only. Had I had the data, I would have been able to do it. And to tell you the meaning of data, please take a look over here. Without data, I cannot conclude whether it is going to increase or decrease. Because at one place I can see increase, at one place I can see unchanged, at one place I can see decrease. How can I comment without data? Over here, again, I am without data. How can I comment? So there can be an increase, there can be a decrease, there can be unchanged. I can't comment, not possible. Are you understanding? Yes or no, please tell me that. Let's go to the 4th case.
Yes.
Vacant land is sold for less than the net book value. Fantastically interesting. Fantastically interesting. They have given us data without actually giving us numbers. What are they saying? That vacant land is sold below net book value. What is net book value? Cost less depreciation. So can I say that book value is, let us say, 10 lakhs? And can I say that the selling price is suppose 6 lakhs? So can I say that I have made a loss on this transaction of 4 lakhs? Does everybody agree with my statements? That I have made a loss on this transaction of 4 lakhs. Agreed or disagreed? Please tell me that. It is a loss. Basics. Danish, you understand this? Yes or no?
Yes, sir, getting it.
Basic, yeah? You don't need to know financial management. Basic accounts, 11th
Yes,
standard.
yes, sir.
Now, pass a journal entry for this sale. Debit what comes in?
Bank account debit.
How much? 6 lakhs, 10
6
lakhs, 4
lakhs.
lakhs? 6
lakhs.
lakhs. How much? 6 lakhs. Why? Utna paisa mila na, selling price you got. Agreed?
Loss on sale account debit.
Credit what goes out? Land has gone out for how much? 10 lakhs.
10 loss on
What is the
loss,
difference?
4 lakhs.
What is that?
Loss on sale.
Loss on sale. Where is loss on sale finally posted? Profit and loss account debit to loss on sale. Agreed?
Yes, sir.
Now look at what has happened over here. Very interesting things have happened over here. Over here, current year's profit has reduced. And over here, bank balance has increased and there is no impact on current liabilities. Therefore, even without data, I can say that current ratio has increased. I can say that current ratio has increased and I can say that current year profit has reduced. What is the question asking from me? The question is asking out of me. The question is asking out of me, which of the following transaction will increase the current ratio and decrease the net profit? Why? Because it is clearly seen over here as per my working notes that your current ratio will also increase and your current year profit will also reduce. Therefore, this option number D is your answer for MCQ number 3456 of Baker. Of what? Of Baker. Agreed or disagreed? Everybody, please tell me that. Agreed? My existing people, Aditya, Monica, Preeti, Sakshi, are you understanding? Yes or
Yes,
no?
sir.
Yes, sir.
Haripriya, you joined us a little late, but I believe you have taken it up, picked it up.
Yes, sir.
Rutvik, understanding? Vivek,
Yes, sir.
understanding? Yes. Danish, I would like to believe that you have also understood it. Preeti,
Yes, sir.
are you understanding it? Yes, Preeti?
Yes, sir. Yes, sir.
Good, very good. So can I say that the second question is solved? See, I can't help it, but I have to discuss each of these in that much depth and length, right? And I'll take a screenshot of your answer also for you. I'll take a screenshot of the answer also. What will happen is you will get this as a justification of the question. Just hold on. Today, when you read the PDFs, you can see this. So this fourth one you will see as the question, and then you will see all these as the justifications of all the four alternatives. Let's go to the third question now. Look at the third question. All of the following are affected when merchandise is purchased on credit except. Interesting. Let us see what happens. Now, merchandise is purchased on credit. Merchandise means what? Inventory is purchased on credit. They are affected. Let us pass first of all the journal entry. So, debit what comes in? Inventory account debit to trade payable. This is the classic journal entry of credit purchase of inventory. Agreed or disagreed, everybody? What is
Yes,
this?
sir.
Credit purchase of inventory. Will my total current assets be impacted? Yes. Due to inventory increasing, total current assets will increase. Total current liabilities? Yes. Due to trade payable increasing, current liabilities will be impacted. Current ratio? Yes. The ratio may increase, it may decrease, or it can stay unchanged. But boss, you have a possibility of it being unchanged also. There is a possibility. Yes, I cannot deny. Let's talk about net working capital. Let's talk about net working capital, and we will again take three cases: case A, case B, and case C. All the three cases I'm taking purposely for your convenience. Current assets are 2 lakhs. Current liabilities are, let's say, 1 lakh. Current assets minus current liabilities is net working capital. What is my net working capital? 1 lakh. Now, because of inventory, let me assume that inventory is of 10,000. I am assuming inventory is of 10,000. Assume inventory is 10,000. So my current assets increase by 10,000 and my current liabilities also increase by how much? 10,000. What is my new answer? My new answer will also be 1 lakh only. Agreed or disagreed? Agreed or disagreed? Yes or no? 2 lakh 10,000 minus 1 lakh 10,000. What is the answer? 1 lakh. Yes? Second case. Take current assets as 1 lakh and take current liabilities as 1 lakh. What is my net working capital? It is 0. Now make over here 1 lakh 10,000 and this will also become 1 lakh 10,000. What is my net working capital? Again, in the second case, again it will be 0. Now it is 1 lakh 10,000 minus 1 lakh 10,000. Agreed or disagreed? Come on, guys, give me the answer. Agreed or disagreed?
Agreed, sir.
Agreed. Third case. Current assets, let's say, is 90,000 and current liabilities, let's say, is 1 lakhs. So what is my net working capital? Minus 10,000. Okay. Now my current assets are becoming 1 lakhs. Why? Because I'm doing plus 10,000. And over here also I'll have plus 10,000. So this will become 1 lakh 10,000. So what is my net working capital now? Minus 10,000. So in both the places, all the places, my net working capital is unchanged. Agreed or disagreed? Please tell me that. What is it? It is unchanged. Yes or no?
Yes, sir.
Remains
Yes, sir.
unchanged. Remains unchanged. With or without data, I can say that it is unchanged. Therefore, what is the only item that is not impacted? It is net working capital. What is it not impacted? Net working capital is not impacted. I hope everybody has understood the calculation and that there are no doubts about this. Agreed? Anybody with doubts? Please speak up. Anybody with doubts?
No, sir.
Let's go ahead. Fourth question. When reviewing a credit application, the credit manager should be most concerned with what? Now, what is the meaning of a credit application? Please understand. What is a credit application? See, in a credit application, what happens? There are two things. Either somebody is asking you for a loan or somebody is asking you for goods on credit. Okay? In a credit application, a party is asking for either A, goods on credit, or B, a loan. In both cases, the party becomes your trade receivable. So whether to give loan or not to give loan will depend on, it will depend on the ability of the party to repay the loan. What is the meaning of repay the loan? To repay its current liabilities. Therefore, profit margin and return on assets do not comment on the liquidity. I'm not interested. Price earnings and current ratio. Current ratio comments on liquidity. Yes. But price earning ratio is concerned with EPS, MPS, not with liquidity. So this is also not my answer. Working capital, yes. is concerned with liquidity. But return on equity is not concerned with liquidity. It has nothing to do with liquidity. Working capital is concerned with liquidity. Why? It is current assets minus current liabilities. And current ratio is also concerned with liquidity. Why? It is current assets upon current liabilities. So what will the credit manager judge? This is outrightly a liquidity measurement. This will be considered. I hope you are with me on that. Does everybody understand why it is option number D? Why it is option number D? Because this will help the person, to decide whether or not to give you the loan or the goods on credit. Does everybody agree with my statement? Yes,
Yes,
or
sir.
no, please tell me.
Yes.
sir.
Any doubts? Any doubts?
No, sir.
Right? Let's go on. So I'll take a screenshot of this. Yeah, so that's your answer. Let's take a screenshot. Now, let's go ahead to the next one. Douglas purchased 10,000 shares of its common stock at the beginning of the year for cash. This transaction will affect the following ratios, except, okay, let me first see what the transaction is. My dear friends, purchase 10,000 shares of its common stock is nothing but buyback of equity shares. What is this? This is buyback of equity shares. And in a nutshell, what happens in buyback? In buyback, equity share capital and number of equity shares will fall. Do you agree? Yes or no? Please tell me that. I am buying back my capital, so my capital is reducing. Agreed or disagreed? Please tell me that. Yes or no? Please tell me that. Are you with me on that?
Yes, sir.
Agreed?
Yes, sir.
Yes.
Just a
Sir,
second.
please repeat.
I am saying that when you do a buyback of the shares, your equity share capital will reduce. You are reducing the capital. That is the meaning of buyback. Are you well versed with what is a buyback? Do you know what is a buyback? You buy
Purch-
back your shares from the market.
Purchasing the shares again.
Purchasing back the shares. So what will
Yes,
happen?
yes.
Your equity shares will reduce.
Yes.
The number of shares will reduce.
How the number of shares will reduce?
Good question. What is your equity share capital currently issued? 1 lakh.
Yes.
What is the face value of one share? 10 rupees. How many shares are there? 10,000. You are buying back equity share capital worth 20,000. Now what is your equity share capital? 80,000. What is the face value? 10 rupees. How many shares are there in circulation? 8,000. Earlier, how many were there? 10,000.
10,000.
Number of shares has reduced.
Yes.
Understood?
Yes, sir.
So number of shares have reduced. And what will happen? And you have to pay the equity shareholders. Therefore, cash will also reduce. Therefore, what will reduce? Cash will reduce. Agreed or disagreed? Agreed? Let's go ahead. Now, debt to equity ratio takes into consideration debt upon equity. It is impacted as equity share capital is impacted. Earning per share is earnings available to equity shareholder divided by number of equity shares. I have explained this 1000 times. Agreed? It is impacted as number of equity shares will go down. Therefore, EPS will go up. I want to discuss this after this particular question. Current ratio. What is current ratio? Current assets upon current liabilities. and cash is paid. Therefore, current assets will go down, but current liabilities are unchanged. Therefore, current ratio will fall. Net profit margin is equal to net profit upon net sales into 100. It is unimpacted over here. It is unimpacted due to buyback. Are you all with me on this? Yes or no? Please tell me that. Are you all with me on this? Yes or no? Please tell me that. Now, I want to talk about this EPS because we have already discussed EPS and I'm getting an opportunity to add some value to that. So, everybody will pay attention to the next order of business. Now, check out what I'm saying. Check out what I'm saying. I am saying the following. I am saying the following. Now, please. I am saying sales, right? Let us say 10 lakhs minus variable cost. Let us say 4 lakhs. Gives me contribution of how much? 6 lakhs. Let us say my fixed cost is 2 lakhs. What do I have over here? EBIT is how much? 4 lakhs. From this, what I paid? Interest. Let us say my interest is 1 lakh. What am I left with? Earning before tax, 3 lakhs. Let us say that my tax is at the rate of 30%. So this will be how much? 90,000. What is this? 2,10,000 is earning after tax. Let us say I have paid a preference dividend of 10,000, for example. So what is this? This is purely the equity shareholders' money. This is earnings available for equity shareholders. This will be divided by the number of equity shares. Let us say that my equity share capital is $10 lakh with a number of 1 lakh equity shares of 10 each. Of 10 each. So what is my EPS? It will be divided by how much? 1 lakh. My EPS is 2. Agreed? Now suppose I do a buyback. Now I do a buyback. I have bought back, let us say 20% of capital. So now out of 10 lakhs, 2 lakhs is bought back. So what is my capital balance? 8 lakhs. Divided by what is the face value per share? 10 rupees. So what are the number of shares? 80,000. Earnings available for equity shareholders are 2 lakhs. Number of equity shares are 80,000. 2 lakhs divided by 80,000. What is my answer? 2.5. So I'm saying that buyback will result in number 1, the number of shares reducing. Number 2, EPS will increase due to it. Hence proved. What was my statement? EPS will increase due to it. This is your concept. This is a takeaway concept. Somewhere or the other, you will be able to use this concept in your essay. You will be able to use it in your MCQ. You'll be able to use it at some place in this journey of part 2. Does everybody understand this concept? Everybody? Yes or no? Give me a thumbs up. Give me a thumbs up. You understand? Yes, guys? Fair enough. So I'm taking a screenshot of this concept. It's an additional concept that we pick up out of the MCQs. Here, I have put this in over. Now, let's go ahead. Let's go to the 6th one. In analyzing the short-term liquidity of a firm, short-term liquidity, most analysts used to prefer the quick ratio or the acid test ratio. That is quick assets upon quick liabilities. What are quick assets? Cash, trade receivables. This is quick liabilities I've written as per Indian. It has to be as per American terms. It's quick assets upon current liabilities. So that will be what? Cash plus trade receivables plus notes receivable plus marketable securities, the whole upon current liabilities. Quick assets do not consider number one, inventory, and number two, prepaid expenses. Why? Because I told you in the first slide, prepaid expenses does not take into consideration any cash movement. It is an expense paid in previous period of current period or in current period of future period. So what is receivable is goods or services. Quick ratio excludes accounts receivable. This is a wrong statement. Accounts receivable, that is trade receivable, is right here. Current ratio includes marketable securities which may be mispriced. No, they cannot be mispriced. They are marketable. Therefore, their price is known in the market. They cannot be mispriced. This is also wrong. Pro forma cash flow statements focus on cash only. Yes, pro forma cash flow statements focus on cash only. Cash flow statement focuses on cash. But is that the reason why in analyzing the primary reason they prefer to use quick? Is this the reason why you're using a quick ratio? No. Conversion of inventory into cash is less reliable. Yes. That is why analysts do not use inventory and they use quick ratio, which excludes the inventory. But what about pro forma cash flow statement? It focuses on cash. It focuses on cash. Therefore, it is used in quick ratio. So this is also wrong. So the primary reason for using quick ratio rather than current ratio. What does current ratio do? Current ratio is current assets upon current liabilities, and current assets will include cash, they will include trade receivable, they will include notes receivable, they will include short-term marketable securities, they will include inventory, they will include prepaid. These two items analysts don't want to use. Don't want to use this. Analysts don't want to use this. That is why they believe that conversion of inventory into cash is less reliable, and that is why they use the quick ratio, which is quick assets upon current liabilities. Am I clear about this, ladies and gentlemen? Have you understood the justification of the answer? Yes or no? Please tell me that. Yes or
sir.
no?
Yes, sir.
Have you understood?
Yes, sir.
Everybody, do you understand?
Yes, sir.
Yes. Let's go to the 7th question. Numericals. So far it was theory, but theory was also very practical oriented theory. So don't feel what theory. I have put out a video on YouTube. I believe it was put out yesterday in the afternoon or something like that. I'm not very sure. Yesterday afternoon we uploaded it. It speaks about the 5 big blunders that you do. And in that 5 big blunders, I have put out a specific blunder that you guys should watch. That is, you start doing this gambling. Theory, practical, theory, what? And you ignore this, do that. Don't do it. Whatever it is marks. Marks are holy. Take it in. That's about it. The following data have been extracted from the financial statements of Hutton Incorporated. Current assets are there. Cash and cash equivalents, marketable securities, account receivable, inventory, current assets, total assets. Current liabilities, notes payable, accounts payable, notes payable, other liabilities, total current liabilities, long-term debt, bonds, and total liabilities. What is Hutton Incorporated's current ratio for the year 1 and the year 2? Well, I don't think it's too complicated. Now, please understand, when I am talking about current ratio, when I am talking about current ratio, I will say it is current assets upon current liabilities. So I have got year 1 and I have got year 2. Please understand that I'm purposely doing this calculation without taking your input for a very simple reason that I'm going to do something additional. A divided by B is your current ratio. What are your current assets in year 1? 12,45,000. This is year 1. I'm putting a circle so that you don't get confused. And year 2, I'm putting a box. Okay. What are the current assets of year 2? 12,60,000. Look into the question. It will give you the current liabilities as well. The current liabilities are 850 for year 1 and 9 lakhs for year 2. Okay. 850 for year 1 and 9 lakhs for year 2. Let us calculate current assets upon current liabilities. That is your current ratio for year 1. It is 12,45,000 divided by 8,50,000. What is your answer? 1.4647. And what about this? It is 12,60,000 divided by 9 lakhs. What is your answer? 1.4. This is your current ratio. I am not interested only in current ratio. Hello. There is enough data in this question for me to calculate extra the quick ratio also. Now this is interesting. Quick ratio will not consider what?
Inventory.
Perfect. It will not consider inventory. So I will brand everything else as a quick asset. Quick asset, quick asset, quick asset. This is non-quick asset. So my quick assets total will be 12,45,000 minus 425 for year 1. I hope you agree. So it is 12,45,000 minus 4,25,000. What is your answer? 8,20,000. And my my current liabilities will stay the same at for this is year 1. So what is that going to be? It will be 8,50,000. Right? This is my year 1 data. So in year 1, what is my quick ratio? It is quick assets upon current liabilities. It is 820 divided by 850. My answer is 0.9647. And now I'm going to year 2. Please pay attention. My quick assets upon my current liabilities. What are my quick assets? My quick assets, it will be 12,60,000 minus, what will I subtract? I will subtract 3,50,000. What is my answer? 12,60,000 minus 3,50,000. What will I get? 9,10,000. And my current liabilities continue to be the same, that is 9 lakhs. My quick ratio is slightly more. And what is that? It is 1.011. Now, I agree that in the question, they must be asking you something else, but I have the ability, this is extra I have calculated. Use is there. What are they asking you? They are asking you current ratio for year 1 and 2. What is the current ratio for year 1? 1.46 and year 2 it is 1.40. Right guys? What are they asking you? Current ratio. Just hold on. So year 1, 1.46 and year 2, 1.40. Can I see that? Yes, 1.40 and 1.46. See over here. 1.40 and 1.46. And this is your calculation for the same. And this is your calculation for the same. Am I clear about this? Yes or no?
Yes, sir.
Yes? Yes? So let's take a screenshot of this. Let's take a screenshot of this. And let me put it out here. Let me put it out here. Right? Let's go to the next question. Let's go to the next question. Now, the next question is, at the end of year 2, Hutton used $100 of cash to buy $100 of inventory. It's the same data. What would be the effect of the following ratios relative to the ratios compounded calculated earlier? What are the ratios they're asking? Current ratio and quick ratio. Now see, you should have this conceptual clarity. What have they done? They have used cash to purchase inventory. So what has essentially happened is, and $100 has been used. So what has happened is essentially cash has gone down by $100 and inventory has gone up by $100. Current liability is unchanged. Current liability is unchanged. So please understand that, and when have they done this? They have done this at the end of year 2. They have done this at the end of year 2. So let's go to year 2. I can see the data of year 2 over here. What will happen to cash? The cash will be 1 lakh minus 100. That is how much? 99,900. Then my marketable securities stay the same, 1,10,000. My accounts receivable will also stay the same, 7 lakhs. And my inventory now will become 3,50,100. So overall, my current assets stay unchanged at 12,60,000. And my current liabilities are the same at the value of, in the second year, they are 9 lakhs. My current liabilities stay unchanged at 9 lakhs. So what is my current ratio? My current ratio is 12,60,000 divided by 9 lakhs. What is the answer? 1.4. And my current ratio is unchanged from original. Now let's talk about my quick ratio. What will happen to my quick ratio? Please understand my quick ratio. My cash will now become 99,900. My accounts receivable will stay at 7 lakhs. My my marketable securities will stay at 1,10,000. Inventory is not considered in this. So what is happening overall is my quick assets are reduced by $100 and my current liabilities are unchanged at 9 lakhs. Therefore, my quick ratio, which is quick assets upon quick liabilities, will fall. My quick ratio will fall and my current ratio will stay unchanged. So what is the moral of the story? The moral of the story is, when a quick asset is converted to non-quick asset, then current ratio is unchanged as overall current asset position is unchanged, but my quick ratio is impacted. My quick ratio is impacted as quick assets reduce. And if current liabilities are unchanged, then in this scenario, my current ratio stays unchanged, but my quick ratio will decline. My quick ratio, what will happen? It will decline. I hope everybody understands this concept. I don't care what they have asked. This is the concept. Once you are this much clear, whatever they must be asking you, don't you think you will have the confidence to answer it? Yes or no? Yes or no? Hello?
Yes, sir.
Yes?
Yes,
Understanding?
sir. Yes, sir.
Understood? Now, this is what they are asking. Now, let us erase what I said. What did I what am I erasing? That current ratio unchanged, quick ratio will fall. Current ratio unchanged, quick ratio will fall. Current ratio unchanged, quick ratio will fall. That is your answer. Agreed? Yes or no? But why is this your answer? The reason why this is your answer, is the logic that we presented over here. That's the logic. That is why this is your answer. Understanding? Yes or no? Yes or no?
Yes, sir.
Everybody, let's take a screenshot. Let's take a screenshot. And let's go ahead. Number 9. They are asking you current ratio of the company. Now, please keep one thing in mind. Please keep one thing in mind. I'm giving you a very important note. Current ratio. Sorry, we'll write it in black only. See, one thing. Current ratio, quick ratio are generalized. What is the meaning of generalized? They use a standard formula. They use a standard formula. What is the standard formula of current ratio? Current assets upon current liabilities. And in this, current and non-current position is impacted due to 12 months outstanding rule and not operating cycle. Operating cycle means today you have purchased goods, then you are going to sell those goods, then you will collect the cash, then you will pay your creditors, then again you will purchase the goods. This is the operating cycle. This goes on and on and on throughout the year. This is not what I am interested in. Operating cycle may be of 5 months, can be of 6 months, can be of 1 month, can be of 5 weeks, can be of 6 months, can be of 8 months, can be of 12 months, can be of 18 months. I am not interested. Current and non-current classification is, as a rule of thumb for financial statement, taken on a 12 months basis. So, what is the current ratio of CPZ? Accounts receivable. Now, I want current assets. What are they? Accounts receivable plus cash plus inventory. What is accounts receivable? 2 lakhs. What is cash? Cash is how much? 1 lakh. What is inventory? 4 lakhs. Upon current liabilities. What are my current liabilities? Accounts payable. 80,000. Notes payable. What are my notes payable? 50,000. What else do I have? I have interest payable in 3 months. How much is that? 10,000. And I have one more item. It is prepaid expenses. It is also my current asset, and that is 40,000. They want current ratio. So is this my calculation of current ratio? Yes. 2 lakhs, 3 lakhs, 7 lakhs, 7 lakhs, 40,000 is current assets. Divided by 1 lakh 30,000, 1 lakh 40,000. What is this? 740 divided by 140. 5.2857 is to 1. They may tend to round this off to 5.29 is to 1, and they can write the answer as 5.29 only, which is fair. Nothing wrong in this. You can take a screenshot of this. Yes, of course, don't worry. We will also click on the right alternative. Where it is 5.29. Right, guys? Hope everybody understood. The calculation. Yes. Let's go towards
Yes,
the
sir.
next question. Question number 10. Question number 10. What are they asking you? What will happen to the ratios below if CPZ uses cash to pay 50% of the accounts payable? Very interesting. What ratios are they asking? Current ratio and quick ratio. Super. Let us make the same working note again. So we'll keep the same working note over here, but I don't think I need this upper wala part. So I'll just rewrite it for your benefit. Okay, I'll rewrite it for your benefit. Don't object. What are current assets? Current assets will be accounts receivable. How much is accounts receivable? 2 lakhs. In this, what I will take? I will take cash. How much is that? 1 lakh. Then I have what? I have inventory. How much is that? 4 lakhs. And I have prepaid expenses. How much is that? 40,000. Now look at my current liabilities. What are they? Accounts payable, 80,000. I have notes payable. How much are my notes payable? 50,000. I have interest payable. How much is my interest payable? 10,000. Do I have any other item? No, I don't. Now what are they saying? It uses cash to pay 50% of the accounts payable. Okay. Now cash is used to pay 50% of accounts payable. How much is that? So 40,000 is paid. Now what will happen? Current assets. Accounts receivable. Sir, they are unchanged at 2 lakhs. Superb. What will happen to cash? It will become 60,000. Why? 40,000 is paid. Then what comes next? Inventory. How much is that? 4 lakhs. Then what will happen? Prepaid expenses will happen. How much is that? 40,000. The whole upon current liabilities. Accounts payable. They were 80,000, but now they will be 40,000 because I paid. Then comes notes payable, which is how much? 50,000. And then there is interest payable, which is 10,000. So what is my answer over here for my current ratio? Earlier, my current ratio was 5.29. Now what is happening to my current ratio? My current ratio will be 2,60,000, or rather I will say it is 7,40,000 divided by 1 lakh. So here it will be 7 lakhs upon 1 lakh. It is 7. So what has happened? It has increased. It has increased. What was the old one? The old one, if you will see over here, the old one was 7,40,000 upon 1,40,000. Correct? Yes or no? That is why it was 5.29. Everybody agrees or disagrees? Agreed? Now the new one is it is increased. Now let's talk about your quick ratio. In your quick ratio, the ones that I am putting a tick mark will come. Accounts receivable, cash will come. Inventory and prepaid will not come. And your entire current liabilities will come. So what was your old quick ratio? It was 3 lakhs divided by 1 lakh and 40,000. Agreed or disagreed? Please give me your answers. Agreed or disagreed? Yes or no, please? 2.14285. Now what will be my quick ratio? New one. In my new quick ratio, I will take cash 60 and accounts receivable 2 lakhs. So it will be 2,60,000 divided by this same thing. But here, see here, it will be 90 and this will be how much? 130. So now what is your answer? Your answer is 2 this time. So what has happened to your quick ratio? Your quick ratio has also increased. What has happened to your, sorry, it has decreased. I beg your pardon. It has decreased. It has decreased from 2.14 to 2.00. Agreed or disagreed, guys? Yes or no? Agreed
Yes,
or
sir.
disagreed?
Agreed.
Everybody agrees
Yes.
or disagrees? So current ratio increases, quick ratio decreases. Are we together on this understanding?
Uh,
Everyone?
sorry, sir, I have a doubt.
Yes. Current ratio increases, quick ratio decreases. The answer
sorry,
is
sir,
wrong.
I have a doubt.
Yes, yes.
The current liability was supposed to be in 1 lakh, right, sir? You gave us 1,30,000
Current liability
in quick ratio.
in quick
Yes, so
2,60,000 divided by the
1 lakh.
accounts payable has to be reduced, right, sir?
Accounts payable 40,000 होगा ना sir?
yeah, it is taken as 40.
So it should be
Old
1.
ratio is 140. 80 plus 50, 130 plus 10, 140. In
Yes.
the new one,
No ratio.
40 plus 50, 90. And this is 1 lakh. This is 1 lakh. I made a mistake. This is 2 lakhs. 2.6. I made a mistake. I'm so sorry. I made a mistake. Now is it okay? So your
Yes, sir.
quick ratio also increases.
Increased. Yes.
Increases from 2.14 to 2.60. So that is why our answer came wrong. That is why our answer came wrong because of a mathematical error on my part. It is not a purposeful error. I am not checking you are paying attention or you are not paying attention. I will not play such games. I made a mistake. I am sorry. Huh? Please. Okay, guys. So the answer here should be both are going to increase. The answer is A. The right answer is going to be A. So A is correct because both our ratios have increased. Agreed? Yes or no? Agreed, guys?
Yes, sir.
Yes, sir.
Yes.
Yes? Okay. Forgive me for the error. Forgive me for the error. Okay. Now let's come here. We have taken more than 2 minutes. So Becker has given us a warning that you are taking more than 2 minutes. But sometimes I am giving you explanation, so that will happen. Now what are we doing in question number 11? In question number 11, we are using long-term debt. In question number 11, we are using long-term debt instead of short-term debt. To do what? To finance a purchase of inventory. Okay. Which of the following, what will the effects be? What will the effects of this be? Well, let us put it down. Long-term debt is used instead of short-term debt. Okay. So we are taking a long-term loan to buy inventory. A long-term loan is a non-current liability. The non-current liability. Therefore, our current liabilities are not impacted. But you are buying inventory. Inventory is a current asset. Therefore, our current assets will increase. What will happen to our current assets? Our current assets will increase. Now, please understand the following concept. They are asking you total debt ratio. Now, please look here. Your total debt ratio is generally, now see, there is nothing like a total debt ratio. There is a debt to equity ratio. There is a debt to total asset ratio. There are so much. So here when I'm saying total debt ratio, I will say debt upon assets. What is my total debts? For example, if I was to say that my debts are 10 lakhs and my assets are, let us say, 20 lakhs. This is my existing position. What is the ratio? The ratio is 1:2. The ratio is 1:2, or you can say it is 50%. Now what is happening? Now my debt is increasing and my assets, right? My assets will also increase. Why? Because debt is used to buy more assets. Suppose if I say I have taken a loan, suppose if I say that loan long term, I have taken off 10 lakhs. So what will happen because of this now? My debt will become how much? 20 lakhs. And my assets will become how much? 30 lakhs. How 30 lakhs? 20 lakhs plus 10 lakhs plus 10 lakhs. Clear? So now what will my ratio become? My ratio will become 2:3 or 67%. Agreed or disagree? Agreed or disagree? So my total debt ratio has increased and my current ratio has also increased. Why? Current assets will increase and current liabilities are not impacted. So my denominator, so when I say current assets upon current liabilities, this fellow has increased and this fellow is unchanged. So my numerator has increased and my denominator is unchanged. Therefore, obviously my current ratio has increased. Agreed or disagreed to this? Yes. What will be my answer over here? This will be my answer. Agreed or disagreed, everybody?
Yes, sir.
Agreed. Yes, sir.
Everybody agrees?
Yes, sir.
See, I am not mutually eliminating the other options. I am justifying why this is correct by taking this example. So automatically all the other options are obviously wrong. Got it, guys? Shall I take a screenshot? Here. A screenshot of this is here. Now. Continuing ahead. Which one of the following changes will most likely increase the quick ratio? Okay. Let's pay attention. Quick ratio is what? Quick assets upon current liabilities. And what are my quick assets? Cash, marketable securities, accounts receivable, notes receivable. That's about it. That's about it. Current liabilities are current liabilities. Inventories are not a part of quick ratio. Therefore, no impact. No impact. Decrease in accounts receivable, my quick ratio will decrease. Increase in short-term government bonds. Increase in what? Short-term government bonds. Short-term government bonds are marketable securities. Therefore, my quick ratio will increase. Decrease in cash will lead to my quick ratio falling. Therefore, what should be my answer for question number 12? It should be option number C. Agreed or disagreed? It should be option number C. Does everybody agree to this statement? Yes or no? Please tell me that.
Yes,
Everybody
sir.
agrees? Yes? Yes?
Yes, sir.
Yes, sir.
This is a rather easy one, the way I see it. Question number 13. Now, let's see. Looks like big options. Current ratio divides current assets by current liabilities, correct? As a measure of the company's liquidity. Yes, it does. Which of the following describes, how quick ratio differs from the current ratio? Look, whatever their options are, first of all, understand. Quick ratio is quick assets upon current liabilities, and current ratio is current assets upon current liabilities. Please understand that quick ratio does not consider inventory and prepaid expenses as quick assets. That's the difference. Whereas in current assets, inventory and prepaid expenses are covered. Let's see the options. Quick ratio includes non-current assets? No. Quick ratio does not include non-current assets. With current assets, no. Quick ratio includes non-current assets? It does not. Quick ratio excludes cash? Blunder. Quick ratio excludes inventory? Yes. And prepaids? Yes, to provide a more rigorous test of liquidity. This is the correct answer. Are you with me on that? Yes or no? Please tell me that. Yes or no?
Yes.
Agreed, everybody?
Yes, sir.
Answer is option number D. What is the answer? Option number D. Done. Question number 14. Acid test ratio shows the ability of a company to pay its current liabilities without having to. So please understand, acid test ratio is nothing but quick ratio. Acid test ratio, it is nothing but quick ratio to pay its current liabilities. So if a quick ratio is considered, you will take into consideration quick assets. What are the assets used? Cash is used. Accounts receivable converted to cash. Notes receivable converted to cash. Marketable securities converted to cash. Acid test ratio shows the ability of a company to pay its current liabilities without having to reduce its cash balance, borrow additional funds, collect its receivables, and finally liquidate its inventory. My dear friends, to pay current liabilities, number one, you have to reduce cash balance as it is paid in cash because the word is paid. Second, it shows the ability of a company to pay its current liabilities without having to borrow additional funds. No. If necessary, you can borrow. If necessary, you can borrow. What will happen? Current liabilities may increase or non-current liabilities may increase, but cash is generated and paid back. It relies on collecting its receivables. Yes, receivables are used. They are quick assets. Look here. They are used. Liquidate its inventory. No. Quick ratio does not factor liquidation of inventory for payment of current liabilities. It does not consider inventory as a quick asset. Therefore, your answer is option number D. Does everybody agree with this statement? Yes or no? Does everybody agree with
Yes,
this?
sir.
Can I take a screenshot? Screenshot is taken. Let's go ahead. Question number 15. All of the following are included when calculating the acid test ratio except. Acid test ratio means again what? Acid test ratio means against what?
Quick ratio.
Quick ratio.
Quick ratio.
Quick ratio. 6 months treasury bills. They are short-term marketable securities. What all is used in quick ratio? Cash, short-term marketable securities, accounts receivable, notes receivable. Prepaid insurance, not considered as a quick asset. Therefore, not included. They are asking you all of the following except means they are asking you what is not included. Obviously, this is your answer. Accounts receivable are included. 60 days certificate of deposit, short-term marketable security. Therefore, what is not included is prepaid insurance. What is not included is prepaid insurance. Again, I will say a rather simple and straightforward answer. Yes or no, everybody? So let's just put more slides. We are going to need them. rather simple and straightforward answer. So we are supposed to discuss 30 questions today. We have done 15 so far. Would you like a break of about 10 minutes? We could take a 10-minute break, 10 to 15-minute break. You could probably eat something if you want to. Maybe it might be dinner time for somebody. I'm not sure. You can eat something and we can continue our lecture after 10 to 15 minutes, where then we will solve dedicatedly in the same fashion with the same intensity. We will go till question number 30 and our liquidity related ratios questions will come to an end. Then your leverage related questions will start, for which I am making it ample clear for you over here that in your sheet over here, this is your Apex Academics. I am giving you very clearly the mandate of what is to be done. This is your ratios sheet. Of course, this is first of all, this was your investment decision sheet, all the lectures. This is your ratio sheet. In your ratio sheets here, you've got the full concept of leverage. You've got this full concept of leverage over here. I request that you go through these lectures. 25th November, we have taken these lectures. Go through these lectures because all the concept of leverage, debt to equity, everything is discussed in this lecture. Watch this lecture thoroughly in tomorrow's day, tomorrow's morning. Solve these MCQs thoroughly and come in the evening, the balance, whatever 30, 25, 40 questions, whatever. And we'll go to the next chapter also. We will finish off those questions. What will happen? You will be able to revise leverage and these other ratios on which the further questions are there. I think it's a good suggestion. You will be able to read and you will be able to participate in the discussion as well. Does that work out for you? Yes or no, guys? Yes, guys? Possible for you to do? Also, second thing, activity ratios, so far they have not asked any questions. I don't like that at all. That is why I say certain times, don't be over dependent on your study materials. I mentioned it yesterday also. Please ensure that you are watching activity ratios lecture also, because if Sargent and Baker don't have enough questions, I will give you enough questions out of my pocket, at least 25 to 30 questions, where we will do activity ratios completely from every possible angle, every possible corner and quadrant. I will complete it thoroughly for you. Do not worry. Yesterday's lecture has been uploaded along with the notes in case somebody has missed out yesterday and needs to watch. So tomorrow you will have enough work to do. You all don't need to now watch this particular lecture of 20 seconds. You all have to go through the MCQs. I will paste the MCQs of this right below this because the MCQs are related to this, right? I will paste the MCQ lecture below this in the sheet, and below 25th November, I will paste tomorrow's. So you are going to watch leverage. You are going to solve the MCQs that I have solved today. You are going to watch activity ratios, and all those of us who have missed out on yesterday's lecture are going to watch yesterday's lecture as well. Am I clear about this? These are my instructions for all the students to do in tomorrow's day, and tomorrow evening we will sit and we will continue ahead. I'm giving you a 15 minutes break. By 9 o'clock and 10 minutes, we will continue the lecture for the balance 15, 20 questions, whatever is left, and then we'll call it a day. All right, so let's continue. These were the instructions that we had before we went on our break. Now, let's come back here. We were on, I think question number 15 was completed or probably 14 was completed. I don't remember.
15 was completed.
15 was completed,
15.
right? So 15 was completed. I think it has gotten refreshed. So let's go to question number 16. We are at question number 16. Let's take a look at question number 16. What does the question say? The following data have been extracted from the books of Hutton Incorporated. Cash and cash equivalents, marketable securities, accounts receivable, inventory, total current assets are given to you. Accounts payable, notes payable, all given to you, long-term debt, total liabilities. What is Hutton's quick ratio for the years 1 and 2? If you notice, we have already covered Hutton's quick ratio for year 1 and 2 in one of the questions that we have solved earlier. So let me just point you to that question. Hutton Here is Hutton, and here we have done quick ratio for year 1 and 2 as well. So what is the quick ratio for year 1? 0.9647, and for year 2 it is 1.011. So I don't think we need to do the calculation. I don't think we need to do the calculation. 0.96 was for the first year, as you can see here. I hope everybody can see it on the screen. 0.96 here and 1.011 over here. So I don't think we need to invest our time in this calculation again. Question number 17, CPZ. They are asking us for a company's acid test ratio. I think we have done acid test ratio also for this question. I'm not sure.
Yeah.
I believe
Yes,
we
it's
have done
done.
the acid test ratio for this question as well. Let me just check and point you towards that in our screenshots. Button CPZ, this is your current ratio. 1 second. No, we have not done acid test, I think. Here, I think we have done, yes, we have done acid test ratio 2.14 and after the change 2.60. I made an error over here. So your answer for this question is 2.14, right? So this question is also taken care of. Now, this is a question we have not done. This is a question we have not done. So let us quickly get this particular question solved. What does this question say? Excel company shows the following accounts in its fiscal year ended balance sheet: cash, marketable securities, account receivable, inventories, prepaid expenses, and current liabilities. The quick ratio is closest to, okay. So quick ratio, again, it is quick assets upon current liabilities, cash, quick assets, marketable securities, quick assets, non-quick assets, non-quick assets, and of course, these are your current liabilities. So what are we looking at? We are looking at 5 plus 26. Oh, 1 second. We are looking at 5 plus 26 plus 7 divided by 50. So this is 38, I presume, divided by 50, right? It's 38 divided by 50. It is 0.76 is to 1, right, guys? So it is closest to 0.76. Taking a screenshot now, putting it out here for you. So easy question. I don't think anything to worry about. Revisionary question. Question number 19. Now they are again asking you over here an acid test ratio for this particular entity. Now what are they saying? Dedham Corporation has decided to include certain financial ratio in its year-end report to its shareholders. Selected information about the most recent fiscal year is provided. Cash, quick assets, account receivable, quick assets, prepaid, non-quick assets, inventory, non-quick assets, current liabilities, non-current liabilities, because it is due in 10 years. Acid test ratio is quick assets upon current liabilities. So 10,000 plus 32,000, the whole upon 15,000 plus 25,000. So this is 42,000 divided by 40,000. So your answer will be 1.05 to 1. That's your answer. So let's see. Of course, we are correct, but what any tricky things? No, 1.05 to 1. That's your answer. So this question also is an easy one, completed comfortably. Right. Let's go to the next question. These are rather easy questions, at least the ones we have done when we are back from the break. Now, question number 20. Again, now they are asking you quick ratio only. Not too much of a problem. Cash, again, quick assets. Account receivable, quick assets. Inventory, non-quick assets. Marketable security are quick assets. Current liabilities and non-long-term liabilities are, of course, non-current liabilities, so not included. So what do I want? I want quick assets upon current liabilities. So 531, 439 plus 2 lakhs. 531, 439 and 2 lakhs, the whole divided by 5 lakhs. So how much does this get to? If you were to check, kindly check and give me the answer. What will be your answer over here? So 531 and this will be 2.34 is to 1.
Yes, sir.
Yes, sir.
2.34 is to 1. Easy. 1.25 is wrong. So 2.34:1 is your answer. Again, easy question. No sweat. I mean, now in your sleep also you should be able to solve these kind of questions. Very easy. Not at all a problem. Question number 21. What is question number 21 saying? This is an interesting question, and I consider this question to be an important one. So gear up for a long explanation to come your way. Excerpts from the financial statement position of Markham Corporation on 30th of April 94 are presented as below. The cash is 725. The accounts receivable net is 1640. The inventories are 29,45,000. The total current assets are 53,10,000. The accounts payable are 12,36,000 and the accrued liabilities are 8,31,000. The total current liabilities are 20,67,000. Assume that the only transactions that have affected Markham during 94 were the dividend transactions and that their closing entries have been made. See, please understand, this is an important dialogue. That the closing entries have been made. What is the meaning of this? Entries have been passed and the ledger balances have been impacted. So all the numbers that you are seeing, they are impacted. The board of directors has declared a quarterly cash dividend to the amount of 8 lakhs. The dividend paid on 28th May 1994 to shareholders of record as on 15th of May 1994. So whoever is the shareholder as on 15th of May has received the dividend on 28th of May. Markham's working capital will be, they are not giving you a numerical answer. Decreased by dividend declaration, increased by dividend payment, unchanged by either. Now let us see. Let me justify everything to you and we will take it one step after the other. So can I say that this position is on 30th of April? So can I say that before dividend declaration, my current assets are 53 lakh 10,000 and my current liabilities are 20 lakh 67,000. So can I say that my net working capital is 32 lakh and 43,000? Do you agree to this statement? Yes or no? Please tell me that. Agreed?
Yes, sir.
Now dividend is declared and we have just written a note that when dividend is declared, a current liability is created. What happens? A current liability gets created. And then what has happened is that dividend has been paid as well. Therefore, the current liability will go down and your cash position will also go down because you have paid the dividend. Because what you have done, you have paid the dividend. So what you will do is that you will create a liability first of all. How will you create a liability? You will book dividend as an expense. And you will create a liability out of it. Dividend payable will have a credit balance. Credit balance is given to liabilities. 8 lakhs. Why 8 lakhs? The amount is 8 lakhs. Does everybody agree with this statement? Do you understand 8 lakhs? Yes or no? Please tell me that. Yes,
Yes,
or no?
sir.
Please tell me that. Everybody agrees?
yes,
Now what will happen? You pay the liability. How will you pay the liability? You say dividend payable account debit to cash account. To cash account 8 lakhs. Now you will say, Arey, we don't have that much cash. We have only 725. I agree to your argument. It is quite possible that you have realized some inventories, you have realized some accounts receivable, and somewhere you have arranged the money out of your current assets only and you have paid because there is no information of additional borrowings. How do I have the privilege of crediting my cash? Because there is no info of additional borrowings given in the question. Do you understand my statement? This is a very, very important statement. Everybody, are you with me on that? If somebody would have said that we have borrowed 75,000 extra I would have assumed that cash has increased by 75 and a short-term borrowing is coming into the picture. But over here, there is no information about any short-term borrowings. No short-term borrowings are made. Therefore, either your accounts receivable have come and paid you the money, or you have sold your inventory and have received the money. Do you understand this concept? Therefore, either inventory or accounts receivable have generated cash. Agreed or disagreed? I want everybody to give me a response to this. It's a very important concept. See, if there was borrowings written, I would have appreciated. Ki chalo, we have got money from somewhere. But while I have a bank balance of 725, if I am paying 8 lakhs without borrowings, it obviously shows that somewhere my accounts receivable and my inventories have realized some money somewhere. Agreed or disagreed? Please tell me that. Agreed or disagreed? I'm waiting for responses from all.
Agreed, sir.
Agreed, sir.
Agreed.
Agreed? Everybody agrees? Okay, now I'll go ahead. Now, after dividend declaration, what has happened? After dividend declaration, my current assets will stay at 53 lakh 10,000. Why? There is no increase in my current assets because of declaration of dividend, but my current liabilities, which were 20 lakh 67,000, will now become 28 lakh 67,000. Agreed or disagreed? Therefore, now my net working capital position will decrease to 24 lakh and 43,000. So, after declaration of dividend, can I say that after declaration, net working capital position has reduced? How it has reduced? It was 3243, now it has become 2443. Now, let us see after payment of dividend. After payment of dividend, let's take a look at what will happen. My current assets, which were 53 lakh 10,000, will reduce by 8 lakhs because I'm going to be paying a dividend. Agreed or disagreed? Therefore, my current assets now will become 45 lakh and 10,000. Yes or no? Please tell me. Agreed? Yes or no?
Yes.
Yes? Now let's talk about my current liabilities. My current liabilities were 28 lakh and 67,000. Yes or no? After the declaration, they were how much? 28 lakh 67,000. And I paid a dividend of 8 lakhs. So now how much have they become? They have become 20 lakh and 67,000 all over again. So now what is my net working capital position? Surprisingly, it comes back to 24 lakh and 43,000. Therefore, after declaration, net working capital reduced, and after payment, net working capital is unchanged. A detailed working has been provided to that extent. Does everybody understand this? Yes or no? Please tell me that.
Yes, sir.
Yes or no? Tell me that. So I'm writing over here also.
Yes.
After payment, net working capital is unchanged. Are you with me on that? Yes or no? Yes or no?
Yes, sir.
100%?
Yes, sir.
Yes? Everyone else? Monica, Aditya,
Yes, sir.
Sakshi,
Yes, sir.
Lokesh, Haripriya.
Yes, sir.
Yes? Everybody? Very good. Let's take a screenshot of this. Now, of course, I will click on the alternative. Don't worry about it. But we have done the analysis of the question. That is more important than the right answer. Right answer kya? Now anybody can give us. What is it? After declaration, it is reduced, and after payment, it is unchanged. After declaration, it is reduced, and after payment, it is unchanged. Now, let's see over here. It is decreased after declaration, and it is increased after dividend payment. No. It is unchanged by no. It is decreased after declaration, and it is unchanged after payment. That is your answer. That is your answer. Are we clear about this? This is a proper mix of theory and practical questions. You need to understand this is a proper mix of theory and practical question. Why? because you have to do the numerical and you have to answer it in theory. So I give this question a white flag. Why? Because this is a good question, because students will tend to get confused when they see the alternatives. Question number 22. From the following data of Hutton Limited. Now Hutton, this time in this question, understand that slightly different data has been given to us. Hutton's data has slightly changed over here. Now, what is Hutton's operating cash flow for year 1 and 2? Now, please pay attention. We are talking about suddenly a new ratio, that is operating cash flow ratio. What is the meaning of operating cash flow ratio? I am writing here as a revision. Operating cash flow ratio checks whether operating cash flows are sufficient to pay current liabilities. Therefore, the ratio is operating cash flow upon current liabilities. That is the ratio. Now you have given 2 years, year 2 and year 1. Operating cash flow is given to you. For year 1, sorry, for year 2 it is 475 and for year 1 it is 4 lakhs. Current liabilities are given to you. Current liabilities are given to you. What are your current liabilities? For year 2, 21 lakhs. And for year 1, 19 lakhs. What will be the ratio? You can calculate over here. For year 1, you can do it as 4. Current liabilities. I have written it wrong. Current liabilities. I have written total liabilities. I have written it wrong. Just hold on. Just a second. Error. Current liabilities. My mother tells me, Pushkar, buy out everything and go. I say, no, you don't know what you're talking about. A sarcastic joke. Please don't take it seriously. Year 1, what will be your answer? 4 lakh divided by 8 lakh 50,000. What are you getting? You'll get 0.4705. You'll get 0.4705. Aage 88 bhi hai. I'm just writing it. For year 2, what will be your answer? It will be 4,75,000 divided by 9 lakhs. What is your answer? 0.527777. I'll write it as 0.528. This is your operating cash flow ratio. Question is solved. What are they asking you? They must be asking you that only. What is the operating cash flow ratio for year 1 and year 2? Year 1, now see the funny part. Always keep one thing in mind. Operating cash flow is not expressed as a percentage. It is not expressed as a percentage. Remember that. No liquidity ratio is expressed as a percentage. But if I was to express this as a percentage, this will be 52.8% and this will be 47.058%. What is the meaning of this? I would like to comment on this. What is the meaning of this? In year 1, your operating cash flows are able to meet 47.058% of your current liabilities. And in year 2, your operating cash flows are able to meet 52.8% of your current liabilities. Am I clear about this? That is what it will mean if expressed as a percentage. So year 1, 47.058 and year 2, we are looking at 52 point something. So this is your answer. Your answer is D. But more important than the answer, in my reckoning, is this explanation. And this is your gold mine for essay questions. As you are aware, we will be discussing essay questions in great depth from both Sargent and Baker. But having this kind of data with you, the meaning wala data with the 4 stars, It will be helpful for your essay type questions. So today when you are revising, ensure that these things are written down in your notebook and you are sending me a PDF screenshot of the notebook that you have maintained so that I have the mental satisfaction that I'm getting good results for January and your paisa vasool is happening in January. Selected financial data for Boyd Corporation are shown below. We will read the data later. They are asking you Boyd's current ratio. What are they asking you? They are asking you Boyd's current ratio. Now let's pay attention. Cash. It is a quick asset. Accounts receivable, quick asset. Prepaid expenses, non-quick assets. Inventories, non-quick assets. Property, plant and equipment is a non-current asset. Accounts payable are a current liability. Accrued liabilities are current liability. Deferred taxes are always a non-current liability and long-term bonds are a non-current liability. Net income does not factor in because net income is assumed to have gotten factored into the cash. That is why net income data is given only to confuse you. Do not make the blunder. Do not make the blunder of adding 96,000 to cash. Sir, why do you say this statement like this? My dear friends, please understand that you have got the year-end balance sheet. You have it or no? So year-end balance sheet
Includes
is
the
made
net income,
only after
P&L.
the P&L has been closed.
Hmm.
From the P&L, the balance of net profit after tax will go to reserves and surplus. Once it hits your reserves and surplus, automatically your asset side will increase. This increase in the asset side can be in anything. It can be in cash, it can be in other assets. It can be absolutely anything. You are nobody to question that because the question does not give you the data. So don't get confused or make the blunder of adding this 96,000 to the cash. This 96,000 is sitting in reserves and surplus. And it is added to assets
Cash.
and it is added to assets as well. Please understand. Please understand. Now, what are they asking us? Current ratio. Current ratio is equal to current assets upon current liabilities. So let's start adding. And they want when at end of the year. So what is relevant for me? This is my relevant data.
31st December.
So what will I take? 62,000 plus
47,000.
47,000 plus
35,000.
35,000 plus
138,000.
138. Anything else?
84,000.
No. Divide this by what?
84,000 and
84,000 and 11,000. Dividing this by 84 and 11. Can somebody give me the answer? What is it? I think it is 2,82,000 divided by, I believe this is 95,000 and this will come to 2.96842 is to 1. So here the students are not actually required to calculate current ratio. They are required to show an understanding of corporate accountancy over here. And I am here for that. Don't worry. So has everybody understood this concept? Is this clear for all of you? Has everybody understood this concept? Is this clear for all? Please respond.
Yes, sir.
Yes? Yes?
Yes.
Monica, Aditya, Danish, Kushi,
Yes, sir.
Yogesh, Haripriya, I'm sure has understood. Nasla, Preeti, Rutvik, everybody,
Yes, sir.
Divya, everyone understanding?
Yes, sir.
Yes.
So, chalo, I'll go ahead. Putting this in your screenshot here. Just hold on. Just come here and gotten rid of this. This was 23. What was your answer? 2.96482. So I'll round it off as 2.97. Okay. It is 2.96 rounded off as 2.97. So I hope there is no problem on that front. Question number 24. Question number 24 is a fantastic question. Why? because it requires you to have knowledge about inventory. So a company decided to change from first in, first out to last in, first out during a period of rising prices. My dear friends, please focus and pay attention. Please focus and pay attention. Here, I have a lot of things to write on the screen for you. So we'll just zoom out the screen as much as possible. Yeah. Let's make writing space. Now, let us understand, we are in a period of rising prices. We are given a period of rising prices. My dear friend, period of rising prices means inflation is prevalent. What is the meaning of both of these things? That purchases will become costlier. They'll become costlier. So now let's take 3 transactions to understand. Let's assume that I have an opening balance. Let's assume that I have an opening balance of units and this is their cost. I have 100 units at a cost of 4. So the value becomes 400. Then I make a purchase on 1st of June of say 400 units, but the prices are rising. So let's say that this becomes 8. So this becomes 3,200. And I have another purchase on 10th of June of say 500 units. Now this time it will become 12 because prices are rising. So this will become 6,000. So at the present moment, I have 1,000 units on hand. The total price of these 1,000 units is 6,000 plus 3,200 plus 400. Your answer is 9,600. This is what I have. So if I am under FIFO, and if I say that I have to issue 800 units to production, how will these 800 units go? First in will go first out. So first I will issue 100 units at the rate of 4. So 400 has gone out. Then I will issue 400 units at the rate of 8. So 3,200 has gone out. Now 500 has gone out. Now another 300 units will go out at the rate of 12. So 3,600 has gone out. So 3,200 plus 3,600 plus 400 is 7,200 has gone out. So what is the value of inventory on hand? So value of inventory on hand is 9,600 minus 7,200. Your answer is 2,400. I hope everybody agrees with my statement that the answer is 2,400. I hope you are with me on that. Yes or no, please tell me. Yes or no, please
Yes,
tell
sir.
me. Agreed?
Yes, sir.
Just 1 second, guys.
Yes.
Just a second. Now, let's go ahead. Now, let's do last in, first out. Now, what will happen in last in, first out? See, in first in, first out, what is in first goes out first. So, technically, what happens in FIFO is the cheaper, older units are issued to production. And what happens? The newer, more expensive units will stay as inventory. Please agree to my statement, because as you will see that the newer, more expensive units are actually staying in inventory. Sir, how? My dear students, these 100 units are issued. These 400 units are issued. But out of these 500 units, 300 units are issued. That means 200 units are on hand at the rate of 12 each. That is why the value of my inventory is 2,400. Now does everybody get a clearer picture of this statement? It is essential that all the students reply that they have understood this calculation. It's a very important
Yes, sir.
calculation. Everybody
Yes,
understands?
sir. Yes.
Yes, sir.
Everyone, give me a thumbs up or say yes. let me
Yes, sir.
understand. Agreed or disagreed? Agreed?
Agreed, sir.
Agreed. Danish, did you understand? Rutvik, did you understand? Preeti,
Yes,
did you
sir.
understand? I'm waiting for responses.
Yes, sir.
Yes? Let's go ahead. Let's go ahead. Now see what happens in LIFO now. LIFO ulta hai. The newer, more expensive units are issued. Why? What is LIFO? LIFO is last in, first out. Whatever comes in last will go out first. What is FIFO? First in, first out. First in, first out. So all the students who have been a part of my part 1 have thoroughly discussed this concept with me. I remember doing this in great depth. I remember. Now, newer, more expensive units are issued, and cheaper, older units stay on hand. So let us look at the issue under LIFO. What will happen? First, you have to give how many? 800 units are to be given. 800 to be given. So what will happen? First, whatever is the newer, more expensive units, last in, first out. What was your last in? 500. So what will go out first? 500 units will go out at the rate of 12. So first this 6,000 has gone out. Now out of this 400, I will give 300 units at the rate of 8. So 2,400 has gone out. So what is the value of my issued inventory? It is 8,400. And what was the value of inventory on hand? Inventory on hand was 9,600. How much? 9,600. So how much is left with me, guys? 9,600 minus 8,400. What is the answer? 1,200. Sir, give us the breakup of 1,200 happily. ये 500 में से 500 पूरा गया, so 500 is out of the picture. ये 400 में से 300 गया, 400 में से 300 गया, 100 बाकी है. At the rate of 8, this is how much? 800. And this 100 units at the rate of 4 are with me. That is why this is 1200. So my dear friends, if I shift from FIFO to LIFO, now understand, if I shift from FIFO to LIFO in inflation, my inventory will fall, my current assets will fall. Therefore, what will fall? My current ratio will also fall. But if I go from LIFO to FIFO in an inflation, my inventory, what will happen? Will rise, my current assets will rise, and my current ratio will also rise. This is the concept. And what you are seeing over here is nothing but proof of concept. Are you with me on that? Yes or no? Please tell me that. Are you with me on that? Yes or no? Please tell me. My dear students, yes or no? Please tell me that.
Yes, sir.
Yes or no, guys? Come on,
Sir.
everybody respond. Yes, yes, yes.
So, can you explain that part again? वो
Which
FIFO
one you
से
will
LIFO
like?
तक
LIFO you want or you want entire explanation?
नहीं सर, बट वो जस्ट वो कॉन्सेप्ट वाला पार्ट जब FIFO
कॉन्सेप्ट
से
को
LIFO
छोड़ो,
तक.
कॉन्सेप्ट को छोड़ो, आप मेरे कैलकुलेशन को देखो. मेरी कैलकुलेशन को देखोगे आप?
Yes, sir.
Now you stay on unmute. Now I
Yeah.
am talking about LIFO. Okay, you start answering me LIFO. In LIFO, what will happen?
Yes.
Last in, first out.
Yes, sir.
So whatever is newer will go out first. Yes. So
Yes,
what
sir.
will go out first? 500 will go out first.
500 units. Yes.
What is the rate of that? 12. So this has gone out.
12.
How much I have to issue? 800. So I give
800.
500. So what is the balance?
300.
This 300 will come out of this 400.
400 units.
At what rate?
8.
8. How much is the value? What is the total
3,000.
raw material issued to production? 8,400. What was my value of inventory total when I purchased it? Look here, 9,600.
9,000.
So now what is the balance on hand?
1,200.
1,200. Let us call this B. Let us call this A. So what is this? B minus A. Agreed?
Yes, sir.
What is the breakup of 1200? Out of this 400, I have 100 units at the rate of 8. And out of these 100 units, I have 100 units at the rate of 4. What is the answer?
4. 1200.
1200. Agreed or disagreed?
Agreed.
Now look at this. We are in a period of rising prices. So see, our prices have increased. 4 has become 8. 8 has become 12. Agreed?
12. Yes, sir.
So when you are doing FIFO, your inventory value is higher than LIFO. Yes or no?
हाँ.
FIFO inventory is greater than LIFO inventory.
LIFO.
Agreed or disagreed?
Yes, sir.
In inflation. Agreed or disagreed? Agreed?
Agreed, sir. Yes.
So if you are shifting now from FIFO to LIFO, will your inventory value fall? Yes, because now instead of 2,400, your inventory will become how much? 1,200.
1200.
What was the inventory here? 2,400. Now it will become how much?
1200.
1,200. So now your inventory will fall? Yes
Yes,
or
sir.
no?
Yes.
If your inventory falls, your current assets will fall? Yes or no?
Yes, sir.
If your current assets fall, your current ratio will fall? Yes or no?
Yes, sir.
Now in LIFO, your inventory was 1,200. Now it is becoming how much? 2,400 under FIFO. You are in an inflation. Your inventory will increase, yes or no? See, it has increased from 1,200 to 2,400. Yes or no?
Yes, sir.
Your
Yes.
current assets will also increase from 1,200 to 2,400, yes or no?
Yes, sir.
And your current ratio will also increase because your current assets.
Also increase.
This is your proof of concept. Got it? Now let us
Yes, sir,
write
got
down the question number over here. The question number is 12859. What is the question number? We are in Becker. 12859 is your question number. Very important question. This is when the theory questions actually come and pose a challenge to us. क्या challenge? कुछ नहीं challenge. डरने का नहीं. Right? I've pasted this here. Now look here. Now a company is doing what? A company is deciding to change from the FIFO to the LIFO. Means in I calculation it was 2,400 and in LIFO was 1,200. Remember? For this refer screenshot. For this refer my screenshot. So what will happen? Obviously, my inventory will decrease, my current assets will decrease, and my current ratio will decrease. So what is your answer over here? What is your answer over here? Current ratio will be reduced. Current ratio will be reduced. This will have no impact on cash flow. This will have no impact on debt equity ratio. And inventory turnover ratio is depending on sale of inventory. No impact whatsoever. There will be no impact. Current ratio will be reduced as FIFO inventory is greater in value than LIFO inventory in a period of rising prices. Are you with me on that? Yes or no? Yes or no?
Yes,
Clear,
sir.
guys? Clear? Are you with me on that?
Yes, sir.
So here I am pasting this for you. Here I am pasting this for you. So this is your concept. This was your concept. One second, let me just rub the screen. So this was your concept I've written, and this is your concept oriented screenshot. Okay, guys? Yes.
So,
Yes.
इसका इन्वेंट्री टर्नओवर पे भी तो इम्पैक्ट होगा ना, बिकॉज
No. See, what is inventory turnover? How many times you are selling the inventory? Correct?
Yes. हाँ.
How many times you sell it is as per your sales potential. Whether you are doing FIFO or you are doing LIFO, how does it matter? The finished goods are ready, you are selling it. क्या फर्क पड़ा?
Okay. ठीक है, ठीक.
Understood?
Yes, sir.
Question number 25. Again, interesting question. These are good theoretical questions. This unit can give you really challenging theory questions. Garstka Auto Parts must increase its acid test ratio above the current level of 0.9. Hold on. What is the acid test ratio? 0.9. Immediately, what I will write over here? इधर ये glossary glossary क्या आ रहा है? Just a second. What are they saying? Grastka's current ratio. What is current ratio? Tell me. Quick assets upon current liabilities. What is the answer? 0.9. So can I say that quick assets upon current liabilities is 0.9? Therefore, what happens after this? Therefore, of course, 0.9 current liabilities is equal to quick assets. Therefore, current liabilities are greater than quick assets. Okay, now, in order to comply with the terms of the loan agreement, now they're taking a loan. Now, to take this loan, they have to increase their quick ratio. How will quick ratio increase? Your quick assets have to increase, or your quick assets stay unchanged, but your current liabilities have to reduce. Only then your quick ratio is going to increase. Expediting a collection of accounts receivable. My dear friends, what is the meaning of this? This means that debtors are converted to cash. Debtors are a quick asset, are converted to a quick asset. Quick assets are unchanged. No increase. What is the journal entry for this? Debtors are collected. So debtors account debit to cash. I'm so sorry. Debtors are collected. So cash account debit to debtors. This was your journal entry for option number A. Correct? Selling auto parts on accounts means credit sale. What is the meaning of this? Credit sale. Let's look at B. What is the journal entry for credit sales? Debit what comes in or debit the receiver. So debtors account debit to sales. What happens in this? Credit sale results in quick assets in the form of debtors increasing. Current liabilities are unchanged. What will happen? Quick ratio will increase. Agreed or disagreed to my statement? Yes or no, please tell me.
Agreed,
Agreed or
sir.
disagreed? Agreed. Making a payment to trade accounts payable. Option number C, you are making a payment to accounts payable. So liability is reduced. So accounts payable account debit to cash. What is happening over here? Accounts payable are reducing and cash is also reducing. Your current ratio is not increasing. Your quick ratio, your quick ratio is not increasing because of this. Purchasing marketable securities for cash. So cash goes out and marketable securities come in. This is also a quick asset. This is also a quick asset. So what is essentially happening over here is marketable securities account debited to cash account. क्या फायदा हुआ? Your quick asset position is unchanged. What happened? Your quick asset position is unchanged. What happens in this scenario? In this scenario, only one thing increases, that is the sales of your auto parts on credit. How are we logically analyzing it? By all the journal entries that have been passed right now. How are we analyzing this logically? By all the journal entries that are being passed right now. I hope you are with me on that. Yes or no, guys?
Yes, sir.
Agreed? Agreed?
Yes.
So tell me, has everybody understood this question? Preeti, yes?
Yes, sir.
Monica,
Yes, sir.
Aditya,
Understood, sir.
Danish, Sakshi,
Yes, sir.
Kushi,
Understood, sir.
Lokesh, Haripriya, I believe you have understood. Nashla, you have understood? I hope so.
Yes.
Rutvik and Divya.
Yes,
Hope
sir.
everybody has understood. Yes, any doubts? Any doubts? Any doubts? Let's take a screenshot. Let's take a screenshot and let's post it over here. So I have posted this. I posted this. Now let's go ahead. Question number 26. Question number 26. What is question number 26? The owner of a chain of grocery stores has bought a large supply of mangoes and paid for the fruit in cash. Okay. He has purchased inventory and paid for it in cash. Journal entry. Inventory account debit to cash account. What has essentially happened? A current asset has increased and a current asset has decreased. Why? What has increased? Inventory has increased and cash has decreased. So current asset position is unchanged. Yes or no? Please tell me that. Current asset
Yes,
position is
Yes, sir.
unchanged. So now let us look at various positions. Let us look at various positions. Current ratio. Current assets unchanged. Current liability not impacted. Current ratio not impacted. Next is working capital. करंट एसेट जितने से बढ़ा उतने से कम हुआ. So current asset is unchanged and current liabilities are not impacted. Sir, how unchanged? अरे तुम्हारा इन्वेंट्री अगर 100 से इंक्रीज हुआ तो कैश भी 100 से डिक्रीज हुआ तो नेट नेट हो गया, तो करंट एसेट जितना था उतना ही रह गया. वर्किंग कैपिटल इज नॉट इंपैक्टेड. नेक्स्ट, एसिड टेस्ट रेशियो और क्विक रेशियो. Your quick assets are reducing and your current liabilities are not impacted. So your quick ratio has reduced. They are asking adverse impact. Of course, it is adverse. If it reduces, it is adverse. And the last one is price earning ratio, PE ratio. What is PE ratio? PE ratio is equal to MPS upon EPS. When this inventory will be converted to sale at that point in time, it will have an impact on EPS. So it is not impacted until sold. Not impacted until sales happens. Agreed or disagreed? Yes or no? I purchase these mangoes,
Agreed.
then I will sell them, I will make a profit, then my EPS will increase. Arre, let me sell them. Right now I'm just buying them. Why are you building castles in the air? Hello. So what is going to be impacted adversely? Only the quick ratio is going to be impacted adversely. Are you all with me on this? Yes or no? Please tell me.
yes, sir.
I hope everybody is
sir.
with me on this. Yes or no? Okay, awesome.
Yes, sir.
So let's take a screenshot and let's go ahead. Let's take a screenshot and let's go ahead now. Number 27. A mobile home manufacturer has a quick ratio of 2:0. Quick ratio. What is quick ratio? Quick assets upon current liabilities. Quick ratio is 2. Quick assets upon current liabilities. Therefore, 2 times current liabilities is equal to quick assets. Therefore, quick assets are greater than current liabilities. I hope you agree to this statement. Assume that nothing else changes. That means current liabilities and quick assets are unchanged. Then which of the following actions will decrease the firm's quick ratio? How will the firm's quick ratio decrease? Quick assets will reduce, current liabilities will increase. Collecting cash from issuing stock. What is the meaning of this stock? This stock is not inventory, these are shares. What are these? These are shares. So let us pass a journal entry for this. Let us pass a journal entry for point number A. Debit what comes in? Cash bank account debit to equity share capital, also called as common stock in America. What is it called as? It is also called as common stock in America. My dear friends, if you're collecting cash what will decrease? This will not decrease. This will increase the quick ratio. This will increase the quick ratio as cash will increase. Writing of obsolete inventory. First of all, inventory has no impact on quick ratio. Inventory has no impact on quick ratio. You need to accept this. How to write off inventory? Very simple. You will say profit and loss account debit because it is a loss to inventory. What you have done is you have credited the inventory, removed it from the books, and you have taken an expense. Converting a short-term debt into a long-term debt. Very interesting. You have a short-term debt. We will call this STD and we will call this LTD. STD is a liability. It has what balance? It has credit balance. Now this STD is converting itself into an LTD. So what is happening essentially? Short-term debt, which is a current liability, is reducing. And long-term debt is created. What is the journal entry for this? Liability to reduce on short-term debt. So short-term debt account debited and create a long-term debt. Long-term debt account is credited. A liability is created. What has happened over here? Here, current liability has reduced. Current liability has reduced. And what has happened? Current liability has reduced and current assets or quick assets are not impacted. What has happened? They are not impacted. I hope you are with me on that. Yes or no? Agreed or disagreed? My dear students?
Agreed.
Agreed so far? Now let's go to the last one. You are buying inventory on a credit with 30-day terms. What is the journal entry for this? You are buying inventory. Inventory account debit to what? To current liability. To what? Current liability. To what? Current liability. So what will happen over here? Over here, your current liability is increasing, but your quick assets are not impacted. Your quick assets are not impacted. Why? Because inventory, what is inventory? Inventory is not a quick asset. It is a non-quick asset. Therefore, what has happened? Essentially, in this, current liabilities have increased. Quick assets are unchanged. Therefore, quick ratio has fallen. Therefore, quick ratio has fallen. So this will impact your quick ratio. Does everybody understand this particular one? Does everybody understand this particular one? Yes or no? Please give me
Yes.
an answer. Agreed or disagreed? Agreed?
Yes, sir.
Yes.
Agreed? Yes? Everyone understands?
Yes,
Come on,
sir.
guys. I know you might be getting a little frustrated, tired, but that happens. Such is life. Everybody understands? Okay. Okay.
Mhm.
Yes. You want to say something? Okay. Let's go ahead. Oh, I did not take a screenshot, right? Wait. Screenshot taken. Pasted. Let's clear the other stuff. Let's go ahead. So I have 3 more slides and I have 3 more questions. Let's see if I can finish them in 3 slides. Chalo. Interesting question. What are they saying over here? Davis Retail has got current assets of 75 lakhs and a current ratio of 2.3 times before purchasing 7,50,000 of merchandise on credit for resale. After this purchase, what will happen? These are your current assets, this is your current ratio. So first of all, I have been given a current ratio. I have been given a current ratio. So let's put here current ratio. What is current ratio? Current assets upon current liabilities. What is current ratio? 2.3. What are my current assets? 75 lakhs is equal to current liabilities. Therefore, current liabilities is equal to what? 75 lakhs divided by 2.3. So what are my current liabilities? My current liabilities are equal to 32,60,870. Am I clear about this? Okay, let's go ahead. Now, they are purchasing. Now this is before purchasing. Now what happens? Now purchase will happen. Purchase of inventory on credit. What is the journal entry for this? Please pass. Inventory account debit to accounts payable. Sir, why accounts payable? Because it is on credit. How much? 7,50,000. 7,50,000. Now what will happen? Now, what is my revised assets and liabilities position? Revised position. Let's take a look. My current assets were 75 lakhs. They will increase by 7,50,000. Thereby becoming how much? Thereby becoming 82 lakhs and 50,000. My current liability that calculated at 32 lakh 60,870. I will add 7 lakh 50,000 to them. What will my current liabilities now become? They will become 40 lakh 10,870. Let us call this B. Let us call this A. After this purchase, current ratio will be, current ratio is equal to current assets upon current liabilities, A divided by B. Your answer is 2.0569. So what has happened? From 2.3, you fell to 2.0569. Therefore, a purchase manager can certainly impact the liquidity position of a company. Sir, why are you saying all this rubbish right now? Because this is what you are going to use to bullshit the IMA and take your essay marks from them. That is what is going to happen. Therefore, your option is it will be lower than 2.3 times. And you're not bullshitting them. You're showing them conceptual clarity by giving these kind of answers. I hope everybody understands this calculation. Very simple calculation. But nonetheless, a purchase manager can impact liquidity position. So expect these kind of questions to come in my mock tests. Because neither Becker, Sargent, Hawk, everybody who's in love with Hawk, you don't get these kind of questions in all those ones. And you have got the market like bad people selling that. Remember, it's not the study material that maketh the man. It's the conceptual clarity that maketh the professional. Always keep this much in mind. Always keep this much in mind. Let's go ahead. How does solvency differ from liquidity? Arey, come on here. I started my lecture with this sermon. What is solvency? Ability to repay long-term debts. What is
Long-term
liquidity? Ability to repay my current liabilities. I think this was the first statement that I made in today's lecture. Liquidity, ability to pay your current outstandings. What is solvency? Long-term solvency is under question. Ability to pay long-term borrowings plus interest thereon. Agreed? We started our discussion with this. So in this question number 29, your option is number C. What is your option? Number C. Am I clear about this, ladies and gentlemen? Yes or no? Please tell me that. Yes or no?
Yes, sir.
So for this,
Yes.
you will refer your first screenshot. What will you do? You will refer your first screenshot of the day. So for your convenience, what I will do is I'll take this screenshot and I'll paste it down over here for you. Just a second. I'll paste this screenshot here. Now I'll take this. I'll take a screenshot of this and I'll put this for you underneath over here. Right, guys? I'll keep this over here. Now, last question, last slide. Let's see what happens. Last question, last slide. Oh, and the last question is pertaining to operating leverage. Last question is pertaining to operating leverage, which we are going to do tomorrow. So we have finished all your liquidity related ratios from Becker today. All MCQs have been discussed. Notes have been thoroughly bred and prepared. Tomorrow's lecture, what we are going to do? We are going to do operating ratios in tomorrow's lecture. You are requested to watch all the operating ratios videos which I have kept online for you. Watch them, come for the lecture. It's going to be a very, very trying discussion because operating ratios are a notch tougher than liquidity ratios. Thank you so much for your time, patience, and attention. Anybody wanting to speak with me, get in touch on WhatsApp or give me a call. I'm ending this call here so that I can start processing of this video immediately. Thank you so much. Bye-bye.
Sir, 1 minute.
Yeah.
How can I have the access or how can I watch the yesterday's lecture?
By taking admission to Apex Academics.
Sure, sir. Sure, sir.
By taking
Can we
admission to
connect?
Apex Academics.
Can we connect after this call on a call?
Yeah, sure, you can. My number is there now on the screen, 7738530054. Okay?
Definitely. Sir. We can-
Yeah, you can call. Just give me 5 minutes. I just want to have a cup of coffee, and you can call me around 10:40 or something. You'll call me.
Firstly, I will message you. Then you say I'll
Yeah,
call.
you send me a WhatsApp. I'll call you back. Okay?
Yes. Thank you, sir.
Okay. Thank you so much.